Hello and welcome back. In the previous session, we have seen a very simple version of a balance sheet, and today we will continue. We will have a slightly more complex version, and moving forward we will have the real version. So, initially we are just giving some idea about balance sheet, profit loss account and cash flow statement, but moving forward we will take up real examples. So, we presume that you have just started your business, and we have seen how much is the total investment. I think it is 7,000 rupees, and then you would like to you have kind of realized that the business is going okay. So, and you are a student, you do not want to spend a lot of time on the business. So, you have hired a person who can sit there during your absence. So, you have decided that salary will be 5,000 rupees a month, and because there is a third person, in order to avoid any kind of misunderstanding, misunderstanding can always be there. It is not a matter of trust, but understanding and misunderstanding, for which you have decided that let there be a billing machine. So, that it will keep inventory information, and then whatever is being sold, it will keep track of the total sales. So, that there is absolute understanding between you and the employee. Now, suppose at the end of first year, say you operated the business for one full year from 1st April 2017 to 31st March 2018. So, now it is the time for you to prepare financial statements, profit loss account, balance sheet, and then cash flow statement. Let us see, this is a very simplistic case. So, these are the data which are available at the end of the year, meaning you have sold stationery worth 5 lakh rupees, you purchase material. From the purchase ledger, you found that total purchase is 2.5 lakh and the like. So, now before you start preparing profit loss account, first one is profit loss account, because I will show you unless you complete profit loss account statement, it's preparing the complete balance sheet is not possible. So, we'll show how we'll see how that statement actually play out. So, these are the kind of a gist of various ledgers. So, now for preparing profit loss account statement, the first construct is gross profit, and the second construct is operating profit, and the third is net profit, and then you pay dividend, and whatever is remaining, it is called retained profit or retained earning. In Indian context, we say operating profit, net profit, then profit before tax. In US, perhaps in other developed world as well, they call it income. But in India, income means we always think that it's a synonym of sales. So, we differentiate between income and profit. We say operating profit, gross profit, and net profit, profit before tax, something like that. So, we will visit that. So, first part is your gross profit. So, let us understand what gross profit is and what is the meaning of that. So, first thing is this does not include your expenses, which are kind of overhead kind of expenses, which are not direct. Gross profit is your raw material cost and other direct expenses like power, fuel, like transportation, like electricity cost, etc., which are direct labor. So, including all of them, whatever is the cost, that is the total cost, and then you deduct that from sales, you get gross profit. It gives you some kind of idea about gross margin, means it is gross margin, but it gives you some kind of ideas to the efficiency of your business, and then you move forward to estimate other profit, other types of profits. So, gross profit for in the previous session we mentioned gross profit for trading business is like your total stock consumption, meaning whatever stock you consume, and that is deducted from total sales, because you do not consume much of direct labor and direct power, fuel, whatever is there, it is all overhead. So, trading business has a very simplistic structure of gross profit, whereas manufacturing will have a slightly different. Moving forward, we will look into that, but for the time being we have to estimate the stock or materials consumed. This material will be used in different names, like say raw materials for manufacturing company. These are raw form. So, normally we refer to as raw material. Time and again we might very well use the same term in retail trade business or trading business, but it is not raw material. They are material, they are also finished material that you sell. You may not add any value whatsoever, but then habitually we use that. Correctly saying is materials. So, what is the gross profit in a retail trade, particularly your stationery business? You remember that your sales is 5 lakh rupees, and how to estimate the materials consumed. Many people actually, even though this is very simple, but many people commit a mistake here, meaning they get kind of mixed up. So, materials consumed is nothing but the materials that you have sold, means the cost of the material that you have sold. And in another words, the people say means in manufacturing terms they call cost of goods sold. So, here we suppose you use the same term or different term, but it is materials consumed. So, it is the cost of the materials that you have sold. You have to estimate that. How to estimate that? Suppose you just try to visualize. Unless you visualize, it will be all too theoretical. Suppose you have this business in your hostel or in some room, wherever. So, at the beginning of the business, on the 1st of April, early in the morning, when you open the shop, you see some stock already there in the shop. So, that is your opening stock, which was the closing stock in the previous day, because nothing happened after the previous day. Just the day of the previous year's closing, you shut the shutter of your shop, and then today you are opening on the first day of the year. So, nothing happened in between. So, whatever stock that you saw in the previous day when you close the shop, you see the same stock when you open it. So, closing stock of the previous year becomes the opening stock of this year. So, you start the business with the opening stock. Then you keep on buying and keep on selling. So, stock gets depleted, you replenish that time and again. So, your purchase ledger actually keeps on adding up. So, at the end of the year, you observe that you have bought a total of 2,50,000 rupees worth of stock or material. And when you ended the business, this or just immediately concluded financial year, that is on 31st March 2018. You started in 2017 1st of April, now it is 31st March 2018 midnight. At 12 midnight you are taking a stock, and you found that still there is 10,000 rupees worth of stock in the godown or in your shop premises. So, you started the business with an opening stock that you inherited from the previous year. Now, during the year you bought 2,50,000 rupees. So, whatever you started with is 5,000 plus whatever you bought is 2,50,000. So, that makes 2,55,000 rupees of stock that was available to you to sell. But then at the end of the year you found that 10,000 rupees worth of stock remains unsold. So, that is to be deducted because you did not sell that, you have not sold that. So, 2,55,000 plus 5,000 minus 10,000, the closing stock. So, your material consumed is 2,45,000 rupees. It is very simple, but important construct. This is how this opening stock becomes closing stock. It is a simple analogy, it is nothing big to understand, but then it creates confusion. So, I kept another slide for that. Now, your gross profit, I think one line got abstracted. So, when you deduct material consumed, that is 2,45,000 rupees from 5 lakh rupees, 5 lakh rupees is your sales that you might remember. So, 5 lakh rupees minus 2,45,000 rupees gives you gross profit. So, how much is the gross profit? 2,55,000 rupees. And what is the percentage? If you are interested in gross profit margin, that is the percentage of gross profit, which is nothing but 2,55,000 rupees divided by 5 lakh rupees, which will be something like 51%. For a trading business, this is actually too much, but then it is just a hypothetical case. Trading business, you normally have margin of maybe 15% to for some goods it might be 25%, depending on the perishability brand of a business. If something is backed by a valuable brand like say Hindustan Lever, Procter and Gamble, normally they won't pass on too much of profit to the retailer. So, retailer's margin is slightly less in those cases. Now, after you estimate, let me see if I have the gross profit margin slide. No, I think something got okay, there is some bit of information moving forward, but in between let me just introduce depreciation. I am not getting into the details of depreciation, their definition, their formulas, there are many methods of depreciations. I am not getting into that, otherwise it will be too much of a diversion and we will lose track. So, just sufficient means it suffice it to say that depreciation is nothing but apportionment of the cost that you incur to create fixed asset. Like suppose you purchase a Xerox machine, it is aside from the example that we are thinking, suppose you buy a Xerox machine, suppose it costs you 1 lakh rupees. Now, you keep on or maybe at the beginning itself you want to price your Xeroxing charge, means per page what should you charge. Suppose your competitors are charging say 80 paisa a page. So, you want to estimate what should be the right charges. Now, you estimate that you are going to make something like 5 lakh copies in the lifetime of the Xerox machine, say just for hypothetically, and if you charge say 50 paisa, you are kind of recovering 2,50,000 rupees out of the Xerox machine. Then there are toner costs, there are things like that. So, suppose toner cost is 1,50,000. So, 1,50,000 goes for toner, say another 1 lakh rupees for is your profit, and you bought the Xerox machine for 1 lakh. If you lose focus away from the cost of the machine, you will kind of think that you are going to make a profit of 1 lakh rupees, because you are earning 2,50,000 rupees, your toner cost is 1,50,000 or say electricity everything together is 1,50,000. So, you have a profit of 1 lakh, but then you should remember that you bought the machine for 1 lakh rupees. So, you are already out of money by 1 lakh rupees, that is to be recovered. When do you recover? You actually recover over the life of the machine. So, gradually you recover in a staggered manner, meaning a small amount. So, there is a systematic way of doing that is depreciation. How you apportion this 1 lakh rupees that you have invested in a Xerox machine over a period of its lifespan. Suppose you think that the Xerox machine will run for 5 years, after that it will become obsolete or due to wear and tear, this machine will become a junk machine. You do not want to do repair and maintenance after 5 years. So, you apportion this entire 1 lakh rupees over 5 years, that means 20% each year, 20, 20, 20, 20, 20. So, that means 20,000 in the first year, 20,000 in the second year, this is the way you want to apportion. So, that is what is depreciation, but we will discuss about that. There are other philosophies. Government of India gives incentives in terms of depreciation, we have just touched upon earlier, but we will have a detailed discussion moving forward. Now, this particular case you have bought some furniture and you have a billing machine. So, furniture total value was 1,500 rupees, billing machine was 10,000 rupees. You think that this will run for 10 years. So, you have decided to depreciate them at 10%. So, furniture original cost is procurement cost was 1,500 rupees, 10% makes 150. So, you deduct depreciation from the original procurement cost, you get book value, meaning in the books of account now it will be 1,350 rupees, which will be the value of your furniture, book value of your furniture, because the furniture has lost 150 worth of value due to wear and tear. So, next year again you will deduct another 10%. So, your book value will keep on reducing and and after 5 years it will become 0, meaning it will not have any book value. Similarly, where in case of billing machine. Now, we have seen that our gross profit was 2,55,000, our sales was 5 lakh. So, 2,55,000 divided by 5 lakh is 51%, that is your gross profit margin. Now, we have to estimate the operating profit. Operating profit is gross profit minus operating expenses, like say salary that you pay to your employee, if you have administrative cost like say selling and administration cost, then you have many other expenses for a retail or for a trading business, or whatever expenses that you incur other than material cost, but excluding interest. Operating expenses do not include interest expense, it includes everything else. Note that income tax is not an expense, income tax is a tax that you pay out of profit. So, do not confuse with income tax being means they are not actually part of expense. So, interest is a part of expense, but this is outside operating expense. So, you estimate add up all the other expenses that came to I think we have a slide on that, maybe moving or we will go back a little bit and see operating expenses. Yeah, everything that you see in red ink, they are operating expenses: salary, rent, then transportation, then telephone, electricity, trade license, depreciation. The one that is in maroon color, like purchase of material, then closing stock, they are used to estimate gross profit. So, that is why I put them in different color, and the blue ones are like closing stock, closing cash in hand, accounts payable, accounts receivable. These are all information, balance sheet information. So, they will be necessary to prepare the balance sheet. They are not expense, neither they are income. So, they do not feature in profit loss account or income statement. So, now we have seen that 93,500 is operating expenses. So, you deduct this from 2,55,000, which was gross profit. So, operating profit is equal to gross profit minus operating expenses. So, then we get 1,61,000, which is operating profit. So, interest we do not have, because your friend is not asking for interest for the loan that you borrowed from him, but if he would have demanded interest, that would have come here. Suppose you have some bank borrowing, that interest comes here. So, operating profit and profit before tax in our case, this particular case, are the same, 1,61,000, 1,61,500. Income tax, now if this is a proprietorship company, then the entire income of 1,61,500 will be added with your personal income, maybe salary or any other consultancy or anything else that you do, will be added together, and then tax will be determined. But for simplicity, means this is not the case with proprietorship. For simplicity, I have taken 30% as flat rate of tax. This is actually applicable for partnership firm, private limited company. The tax rate is flat 30%. Beyond 1 crore, another 10% surcharge is added, but below 1 crore it is 30%. But for proprietorship firm it is different, but just for convenience I have taken 30%. Deduct the tax from profit before tax, you get net profit. So, profit before tax and net profit are very different. Profit before tax minus income tax is net profit. So, that kind of brings us to the net profit figure. Now, you are a businessman and you are looking forward to getting some money out of the business. Had it been a partnership firm or a private limited company, you actually pay dividend, not really for proprietorship firm, because for proprietor every penny, every money is his or her money, whosoever is the proprietor. So, you are actually for proprietorship firm this concept is not there, but for partnership and other limited liability companies you pay dividend separately. So, suppose you have decided to pay dividend of 50,000 rupees to the founders. So, out of the net profit you pay dividend of 50,000. So, you are left with 63,050 rupees, that is normally termed as retained profit. In US it is called retained earnings. So, this money actually goes to the balance sheet as owner's equity. The entire 1,13,050 belongs to the owner, but they have taken money back home, that 50,000 rupees, that does not remain in the with the company. So, what remains is only 63,050 after payment of dividend. This is the retained earning and owner's money actually. So, this is added to reserves and surplus or retained earning in balance sheet, we will say that. This is the entire thing at one place. At the top you have all the list of expenses, and bottom we have this gross profit calculation. So, gross profit you can see is 2,55,000, this gross profit margin is 51%, then operating profit is gross profit minus operating expenses. Now, this is an image of Reliance Industries profit loss statement. So, you can visit that, I have given the link. Otherwise, for any other company, if you are interested to find the balance sheet, you have to go to their annual statement, and the annual statements are available in BSE India Limited, bseindia.com. It is available in other places as well. You can visit the company website, but in BSE all the listed companies financial statements are available. So, you punch this data bseindia.com, and then there is a text box, a search text box, that is get quote, and then you type a few letters of the company, then there will be a drop down menu from where you select the name, and then you press Ctrl F for finding. You find wherever you have the annual report link, press the link, you will find many annual reports, all the annual reports of the previous years. So, we move on to the balance sheet. Now that we have this information, that is retained earning. After you have retained earning, you can go to the balance sheet. Before that, you cannot complete. That is the reason. I will show you. So, previous session we have seen that balance sheet starts with assets, and asset starts with the most liquid asset. But if you look into Reliance Industries balance sheet, you will find that they start with the most illiquid asset, that is fixed asset. But in Western world, they start with the most liquid asset. It makes sense, whatever, it is just a matter of convention. Data wise, there is no difference whatsoever. So, let us forget about that part, that complexity. So, we start with cash. Cash is the most liquid, and we observe that cash, again cash comes only after you prepare cash flow statement. Before that, it does not come. So, we cannot say that closing balance, perhaps I wrongly mentioned closing cash is this. Here I mentioned closing cash in hand 800 rupees, that was something hypothetical, that is not right. There is a mistake here. What is closing cash, that should arrive, that you should be able to arrive at after your cash flow statement, that I will show after I show the balance sheet. So, you cannot actually start the balance sheet unless you do the cash flow statement. It is kind of a either this or that, but even for doing cash flow statement, you will have to, means if the balance sheet is almost semi finished, in a semi finished state, it will help you to prepare the balance sheet, because you need to understand whether the current asset has gone up or down, current liability has gone up or down, or how much is the increase or decrease. Only that will help you to prepare the cash flow statement. That is why balance sheet also is necessary to be prepared before cash flow. So, you kind of simultaneously start all, but know that cash in hand or cash in bank information has to emerge out of cash flow statement. So, after cash it is accounts receivable. This data will be available in your books of accounts. So, if there is a sum somewhere you have to solve, you should ask what is the accounts receivable data. You cannot really invent that, neither you can estimate from anywhere. This data comes from ledger, meaning at the end of the year you see the balance in the ledger of accounts receivable, whatever is the data, you just supplant it here. Similarly, inventory also comes from a ledger. Then comes your fixed asset, that is furniture, fixture and machinery. We have seen the value here, just a preliminary estimation of depreciation, here. See, your furniture procurement cost of 1500 rupees, if you prepare a balance sheet on the same day, it becomes 1500, but if you prepare a balance sheet after a span of say 6 months or so, then you have to allow 100% depreciation, which means 10% full depreciation. For 6 months period, normally there is a convention that you allow only half the depreciation, that means 5%. Forget about that complexity for the time being. Let us know that at the end of the year, whatever assets you had, that only the net value or the book value should appear in your balance sheet. So, in case of furniture, your procurement cost is 1500 rupees, you depreciated that by 150. So, what is left is 1350, that is the book value, that should be presented in your balance sheet. Similarly, 9000 should be presented in case of your billing machine. So, here your furniture fixture, then book value is 1350 rupees. Next year you will allow another 150 rupees of depreciation. So, book value will become 1200 rupees, and that should come in your balance sheet in the next year. But this year, that is the book value, and that is to be presented here. There is a system, many companies mostly follow this process, that furniture fixture as per book value of the last year minus depreciation. So, this is the net book value. Similarly, machinery, we have just the billing machine. So, that is the machinery. In the liability front, we will start again with the most liquid liability, that is account payable, meaning that they are to be paid immediately. They can telephone, and then we have to pay them. So, that is most liquid. So, we put that at the beginning, and then short term bank loan also is current liabilities. We start with current liabilities. So, I have actually made two separated balance sheet into two components for visibility, but it should be in the same page. Obviously, the other day I mentioned that it can be done side by side. On your left there may be asset, on your right it might be liability, whatever that is. So, liabilities starts with current liability, and then long term liability is not called anything else, but long term liability. Current liability has short term bank loan as well, but for the time being we do not have any bank loan. So, if that would be there, bank loan balance will be available from the bank. So, this information has to come, you cannot estimate that. Whatever you cannot estimate has to come from books of account. In an examination context, these are to be provided. So, long term bank loan, long term liabilities, first item is long term bank loan. There is no hard and fast rule which come first, because everything is kind of a long term in nature. So, there is like if the okay. So, long term bank loan is 0 because there is no bank loan. Other loan means your friend has to get some money, you have repaid 2000 rupees during the period that is given in the sum. So, 2000 rupees is still outstanding, means pending to be given, that is the outstanding. Then owner's equity, you start the business with 3000 rupees, that is your equity capital, not equity. I have a habit of calling equity, but it is equity capital. So, then retained profit. See, retained profit is earlier year there was no retained profit, because you have eaten away everything. You made 15,000 rupees of profit, 12,000 is gone, 3,000 rupees you have invested in the business now. So, 3,000 rupees is the equity, and you have made a surplus in the profit loss account of 63,995. The same amount should come here. Suppose next year you make another, say 1 lakh rupees of profit, not profit, 1 lakh rupees of retained profit, meaning after payment of dividend you have 1 lakh rupees. This 1 lakh rupees will be added to this 63,995 rupees, meaning every year this balance is carried forward. So, 63,995 will be carried forward, and it will be added to the new years, the next year's retained profit, retained earning. So, if the retained earning is 1 lakh, that is to be added to 63,000. So, in the next year's balance sheet it will be 1,63,995, and total of the liability side is 80,995. Total in the asset side also is 80,995. Why so? Because asset side is the application of money, liability side is the sources of money. In that sense, actually liability, if the liability comes first, asset come later, makes some sense. So, here is the both of them placed side by side or in a column. So, you can see that 80,995 is the sum of asset, same is the sum of liabilities, because total you cannot create asset more than the money you have. This is the sources of money, and that is the application of money. So, that is why they are same, and this is a screenshot from Reliance Industries balance sheet. I have just separated the two for visibility, because the font size is so very small. So, you can have a look. There are other items, we will discuss that later. Now, we are not trying to create any kind of confusion. So, I have kept it as simple as possible. So, we will close the session here, and then next session we will see cash flow statement. Thank you.